Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is Chief Investment Strategist at RIA Advisors, also the Editor-in-Chief of Real Investment Advice. He also does a weekly show available now on Wealthion with Adam Taggart, a weekly market wrap. Lance Roberts, thank you for joining me again.
Absolutely glad to be here.
So, Lance, before we start talking maybe about asset classes, charts, things that you look at on a daily basis or at least Monday through Friday, I want to get your thoughts on the global economy, the state of the global economy. What do you think are the biggest risks to the global economy right now?
Well, I mean, look, it used to be back in the day, we actually talked about fundamentals, right? Valuations and earnings and those type of things. But today it's all about, the central banks, right? What are global central banks doing? Are they adding liquidity? Or are they taking away liquidity? And this is the one thing I really don't understand what people don't get right now is that the central banks globally are taking away monetary accommodation. They're raising interest rates, and they're doing that in order to crush inflation. And in order to crush inflation, you have to slow economic growth to get job growth down, to get wages down. And none of that plays well because the economy, which is where earnings come from for corporations, will have to slow down in order to quell inflation, which means lower earnings. Estimates are still 20% above their long-term means. Those have to come down. And you're going to have, if with central banks hiking rates and still doing it fairly aggressively, we're going to have a recession next year. And that's going to mean lower asset prices. And there's not really much a way around the math.
And we're recording this interview on Monday, December 19th, 2022. The dollar index is back above 105 at 105.63. The yield curve continues to get inverted. So you think that the Fed doesn't really care about that much right now, that their main objective is to fight inflation?
Well, that's what they say their main job is right now, is to bring down inflation. They're worried about inflation becoming entrenched, which would be problematic in theory if you had a low debt society and the ability for people to generate higher rates of income growth, generate stronger economic growth. The Fed is looking back at the 1970s and going, we don't want that to happen again. Well, today's economy is vastly different than what we had back in the 1970s. In the 70s, we were primarily manufacturing based, which has a huge multiplier effect in the economy. For every dollar spent on manufacturing, it generates about $5 of economic growth. Services have basically a one-to-one relationship to the economy. And even when we start talking about a lot of the services are generated through the recycling of taxpayer dollars, there's almost a negative impact, or what we call a negative multiplier effect on the economy in a service-based economy. So to generate high savings rates in the 70s, we had 8% savings rates, 8% rates of economic growth, lots of manufacturing base, low debt ratios for households. The average debt to net worth was about 60% versus 150% today. So, back then you could sustain much higher rates of inflation because it led to stronger rates. It was a function of, I should say, didn't lead to, but it was a function of the strong economic growth at the time. Today, you have basically no savings for 80% of the economy, high debt ratios, as I said. So high inflation is more problematic today than it was back in the 70s because people can't afford the cost of living, right? So every time inflation goes up, people have to go more into debt, those type of things. So what the Fed's afraid of is inflation becoming entrenched and leading to a very deep recession in the economy. And so, yeah, right now, to your point, Jason, they really don't care much about the yield curve because that's what they view as a function of what they're doing. They're hiking rates on the short end, which is what they control. The economy controls the long end. So that's inflation, interest rates, economic growth. That's what happens on the long end of the curve. And that's inverted right now. That means you're going to have a slower economy. And when that yield curve uninverts, that's when the recession will actually be setting in. We're not there yet. That'll probably be first, second quarter of next year. And then the Fed will have to figure out what their next steps are going to be. I mean, ultimately, they're going to have to start cutting rates, reversing policy in order to try to bail out the recession. And the big balancing act is, can they create a recession without it becoming an outright depression, and then bail it out in time before it turns into a depression. And so that's a hat trick we'll have to wait and see for next year.
Yeah, I mean, the track record for the Fed for Fed pivots and soft landings is very, very low. The probability of them doing that successfully is close to zero, I would say.
Yeah, I've written that more than once, and it's so funny because people go back and they go, well, the Fed's hiked rates before and you didn't have a recession. Well, 1994 was a good example. They hiked rates. We didn't have a recession. Well, it's because we just came out of a recession in 1991. And what everybody forgets is 1994 was the bond market crash. So, they cause problems. It may not always cause a recession. So you look around and say, oh, it's a soft landing. It's kind of a big bunch of hooey, because they either break something economically or financially every time they start these rate hiking campaigns. And this time won't be any different, to your point.
Oh, yeah, I totally agree. I mean, they're potentially going to break corporate debt, junk bonds, consumer spending. Real estate hasn't broken yet here in the United States. I mean, I guess you could argue that commercial real estate is crashing now with the amount of businesses that are closing down locations and canceling their leases. But we haven't had a big crash yet in residential real estate prices.
Not yet. But and again, look, and there's a couple of things that are a bit fascinating. Jason, right now, we've got near the largest amount of inflows into passive ETFs since 2009, the highest level since 2009. And of course, a lot of this money is coming out of actively managed funds, and people are just dumping it into passive ETFs, just hoping to get some type of return on their money. But those passive indexes distort markets, because every dollar that goes into a passive ETF, 30 cents of it goes to about the top 10 stocks in the index. The other 60 cents goes to the bottom 490 stocks. So there's a bit of a distortion that occurs with this passive indexing. And the same thing goes for housing to some degree, because, right now there's this standoff between buyers and sellers. And the buyers are going, I can't afford a 7% mortgage, so you have to come down in your price if you want me to buy your house. Homeowners are going, I'm not lowering the price of my house because, I like the price value where it is, right? Because my house is worth this much and I'm not coming down. So there's this standoff in the real estate market. And what's going to be interesting is whether or not the home sellers can stay there long enough at high prices and allow us to go through this cycle to where the Fed starts dropping rates again, bringing mortgage rates down to where the buyers can then step up to meet the sellers. So the question is, it's kind of a race against time. Do sellers have to come down to meet buyers, or do buyers are eventually going to have to come back up to meet sellers? And I don't have the answer for that, but next year is going to be pretty interesting, I think, with the housing market.
Yeah, I agree. I think 2023 is actually going to be rough for all levels of the U.S. federal government and the state and local governments for a number of reasons, because if there is a recession or depression, historically tax revenues collapse. So we're going to start to see the sales tax revenues collapse. The consumer will not be going out to eat at restaurants, bars, shopping. They will not be doing that as much. So that will be sales tax. Income tax revenues in a recession or depression also fall. And then you have capital gains tax revenues, which a lot of the retail investor are long only. So stocks, bonds, real estate, the normal capital gains tax revenues at the federal level, those could also fall. And then finally, probably the last group of tax revenues, if we do have that real estate crash in residential, we could have property tax revenues where property taxes fall. And then if governments are trying to either raise property taxes, people are finally going to balk at the hikes of property taxes.
Yeah, that's a good assessment. I don't disagree with that at all. And again, we keep, the other side of that is tax revenues are coming down, and you're correct about that. And that means the debt keeps going up because we keep, just kicking the can down the road by doing these continuing resolutions. We just passed one to help fund the government, for like a couple of weeks. Then we got to pass another bill to try to fund the government next year. We don't pass a budget anymore. We just pass these continuing resolutions, and the secret in that is that it just increases the spending by 8% every year. So whatever the budget was last year, they tack on 8% to it. They pass this continuing resolution and stick in a bunch of dog ears, for additional spending here and there. But the spending just keeps going up. Tax revenues are coming down. Right now, it requires more dollars just to fund what we call mandatory spending. And so mandatory spending in the government is Social Security, Medicaid, welfare, basically your entitlements, right? Social Security, Medicaid, prescription drug benefits, the Affordable Care Act. and interest on the debt. That's it, right? That's pretty much mandatory spending. It requires more than 100% of all the tax dollars that we bring in just to pay for that. That doesn't include all the other non-mandatory spending we've got to cover, which requires debt. And to your point, Jason, if you're right, and if I'm right about having a recession next year, those revenues fall, which means that it's going to require even more debt to be issued. And so you see the problem here going forward.
Yeah, I see a math problem coming at some point in 2023, especially if the Fed wants to keep hiking rates. I mean, we're already at dangerous levels for interest payments on the national debt. I think we're over $700 billion per year just in interest payments on the national debt at the current interest rates. And there's a lot of debt. I don't know the exact number, but it's a lot, many trillions that needs to be rolled over new debt. And it's going to be issued at higher interest rates. So the US Treasury, just to service the debt, next year in 2023, looking at $1 trillion per year. And that's probably low on the base case. I mean, it could end up higher than $1 trillion per year.
The trajectory is going to accelerate. And the problem with that, of course, is that the more debt you have, the slower rate of economic growth you have. And the slower rates of economic growth you have, the less inflation you have, which, again, this is why we see so many individuals, on social media, having these debates about we need socialism, capitalism's broken, it doesn't work anymore, we need more free stuff. And that's just a function of where the economy is going to, and slow growth rates, economically speaking, are going to make that worse over the next decade.
Well, you can also have stagflation for a long period of time. I mean, governments after World War I, after World War II, they had a lot of inflation while the real economy, they tried to inflate the debt away while the real economy was not growing. So we may be similar to that, because the fight for the pandemic, these governments and central banks, it wasn't just the US, they printed tons of currency, increased government spending, handed out stimmy checks, and that was a lot of extra debt. And now these governments, they are raising interest rates, but there's going to be a limit to that because they've issued so much more debt, they're not going to be able to keep raising interest rates.
Yeah, that's right.
Yeah, so it looks similar from a financial history perspective to a post-war environment.
Yeah, I would only say that the big difference between post-World War I, post-World War II is you don't have near the magnitude of debt to deal with. And for instance, like, post-World War II, everybody came back from the war. We were the only manufacturing base left in the world. Germany was bombed out, France was bombed out, England, Japan
too, yeah.
They were just all bombed out. And so we were the manufacturing hub of the world, which is why the 50s and 60s and 70s were so strong, economically speaking. Today is a vastly different world here. And while, certainly stagflation is a possibility. I mean, there's you can't say that, it's absolutely not going to happen. My bigger concern is I think we have more of a deflationary environment as the magnitude of that debt weighs on the actual population, which doesn't have the savings to, withstand a much slower growth rate economy. And that's just going to continue to weigh on them. And again, I don't know exactly what the outcome is going to be, but, the Fed says they're going to hike rates to 5.25%. They're going to leave them there until they're sure that inflation is broken. My suspicion is if they get to 5.25%, which is possible, and I think they're dead set on doing that, it's not going to stay there very long because they're going to break something sooner than later.
I agree. And in a deflationary environment, from a financial history perspective, which types of asset classes tend to do okay? Because in a deflationary environment, you're looking in the private sector at bankruptcies, you're looking at companies not being able to get credit, you're looking at consumers not being able to spend and cutting back. So which asset classes historically in deflations tend to at least do okay?
Well, I mean, whenever you're in a deflationary, recessionary type of environment, which is kind of what we're talking about next year, theoretically, this is going to come down to really getting back to here's the thing. Passive investing is not going to work. And the reason is you're, the type of environment we're talking about next year is not going to be good for equities at all, right? I mean, I mean not at all, like just in general, but all equities aren't going to perform in general. And it's going to really come down to, picking those companies, and the ones you want to focus on are companies that people can't live without, right? Things that I've got to have. I'm still going to go to Kroger's and shop. I'm still going to go to, Walmart, buy what I need. I'm still going to go to Target, those type of companies. And then, of course, on the utility side, people are going to have to pay their bills. They're going to have to, regardless of how bad the world gets, they're going to keep their lights on. They're going to pay their water bill. If you're a muni bond buyer, you only buy muni bonds and basically power, water, sewer, right? Things that people have to pay for. Companies that can generate growth regardless of the economic environment. So, so some of your technology companies that have strong earnings growth rates and can continue to maintain that in a deflationary environment, that's where you want to be focused. Things I don't want to own are very discretionary items that I don't have to have, or B, I can't afford, but I can live without them, right? So, things that
Netflix subscription.
Yeah, exactly. Those are the things that you want to avoid, because they'll be the ones that basically people start doing that. And that's where earnings are going to come down the most.
Also, in past deflationary environments, especially if there's bankruptcies. So if the Fed keeps hiking interest rates, we could see junk bonds, collateralized loan obligations, these derivatives. A lot of private sector companies go bankrupt. I think that's the thing that a lot of people who haven't studied financial history aren't aware of about what happened after October 1929, the stock market crash and the Great Depression, was how many bankruptcies were caused by government policies and higher interest rates and the consumer stopping to spend and trying to hoard cash and rebuild their savings and rebuild their balance sheet.
Yeah, no, that's right. And look, right now, if you take a look at small mid-cap companies as a good example, 20% of the Russell 2000 are what we call zombie companies. I think you and I talked about this previously. But these zombie companies are companies that are reliant on low interest debt in order to keep operations going. And with interest rates coming up, a lot of that debt's going to have to be refinanced. So there's going to be, to your point, we'll see quite a few bankruptcies potentially in that small to mid cap space. But there's a lot of companies that depend on debt just to operate. And so when you get into a deflationary, or even stagflationary, really, Jason, but in a disinflation environment, that's going to become much more problematic for these companies to refinance again with slower revenue growth and operations. So you guys, and this is to my point, is this is really, if what we expect to happen happens, and look, and let me just be clear about one thing. I don't want people to walk away from this interview going, "Oh my God, you're so bearish, right? The world's coming to an end." I'm not saying that at all. My big challenge right now is trying to figure out how in the hell do we not have a recession, right? That's, how can I position the portfolio for a no recession type environment? Because there's people out there that suggest we could have a soft landing, right? The Fed might actually be able to engineer it. And it is a possibility. We can't completely disregard that possibility in managing our portfolios, right? So we have to consider that potential. But I can't really wrap my head around how do we do that with the Federal Reserve intent on hiking rates more, doing quantitative tightening, doing everything they can to lower the inflation rate and raise unemployment. I don't know how you avoid the recession. And the trick is going to be, and then this is going back to the small cap mid-cap problem, is that the trick is going to be engineering that quote unquote soft landing scenario without blowing up all these companies that have been surviving on cheap debt that are facing a fairly big waterfall of refinancing coming May, June of next year.
Another major problem is dollar strength. So you have the total amount of dollar denominated debt outstanding outside the United States. So the Fed says they don't really care about that. But when the Fed raises interest rates and the dollar rallies against other currencies and there's inflation in other countries, the strong dollar becomes very, very onerous. So I've called it basically a global margin call. So you talked about bankruptcies in these zombie companies. There was more zombie companies in the European Union than in the United States. So you may have a lot more bankruptcies in the emerging markets and the European Union than in the United States.
That's right. And Jason, that's one of the big calls for next year, right? So at the beginning of let's see, what year is this? So at the beginning of 2021, I think this was like January, February of 2021, I got into an argument with one of the journalists over at MarketWatch. And he said, the dollar is going to it's going to be, strong and it's going to be, rising. I was like, no, dollar's going to be really weak this year. And that's what it turned out to be. We had a big weakness in the dollar in 21. But that set up for that weakness in 21 set up for this big rally we've had in the dollar, in 2022.
Yeah, it's a cycle.
Yeah.
When the dollar's weak, Lance, I know you pay attention to this, but when the dollar's weak, you always see these foreign corporations and foreign governments, they borrow more dollar denominated debt.
Exactly. And that's my whole point, is that, these all things cycle. We've had a huge run in the dollar this year. I think there's and now the question is will the dollar weaken relative to other currencies, next year? And there's certainly some factors that go into that both ways, right? So, first of all, if you have a recession in the US, that tends to lead to a weaker dollar, right? Because money comes out of the US to go to other stronger economies. The problem is, and to your point, Jason, is that we're talking about a global recession. So if you're hiding your reserve currency in US dollars, and by the virtue of that in US Treasuries, where you get a higher yield, where are you going to take your money to, right? If everybody's in a global recession, it bodes to the fact that we could see a rather, either a stronger dollar or at least a dollar that remains strong-ish relative to the rest of the world. And here's the big problem with that, going back to earnings in the stock market: 40% of international revenues are, come from international sales, right? So when you take a look at corporate sales or revenue, and you say, okay, so, Apple, IBM, Microsoft, whoever. So 40% of the revenues are generated by international firms and international sales, our exports. So if that's the case, that dollar makes all those exports much more expensive, which is going to impact the revenues of these companies even more. So, the real headwind next year, and to your point, is this dollar remains strong. Doesn't mean it has to go back to all-time highs, but it could just remain strong relative to other currencies. And that's going to further impact corporate revenue growth for corporations in 2023 at a time that profit margins are coming down. All that, that pig in the python of monetary liquidity, of all the fiscal stimulus, the stimmy checks, et cetera. That's all exiting the python now. If you take a look at recent retail sales, tells you all you need to know. So, there's going to be a real challenge to generate earnings and maintain profit margins next year.
And in this type of environment, if we do have a lot of bankruptcies outside the United States from foreign companies, foreign governments have dollar denominated debt problems, people will be looking for safe havens historically. That's when in post-October 1929 crash, other recessions or depressions, as long as it's not where inflation is rapidly increasing, at least not in the United States, it looks like inflation may have peaked, even according to shadow stats, at least temporarily. The US dollar, US Treasuries, and gold tend to be viewed as the safe havens.
Yeah. Well, so, and again, this is, I try not to, okay, so I'm going to spit this out. As a portfolio manager, my job is to try to evaluate the best places to put money, right? And so, maybe it's gold, maybe it's not. Maybe it's bonds, maybe it's not. Maybe it's stocks, maybe it's not. And so, our job is to try to measure and manage the risk. So when you talk about gold as an example, that could very well be a very good place to have capital next year. That all depends on real yields. So that's yields minus inflation. So you take a look at real yields. There's a very high correlation between gold prices and real yields. If it's going to be commodities, that's going to be a function of the global recession or not, right? So it depends on the depth of the recession. If you're having a global recession, the demand for commodities are going to fall. So there's risk to general commodities. And then we've already talked about stocks. They're going to have a risk because of lower earnings, because of kind of an economic slowdown due to the global recession. Bonds should do well in that environment because, again, people looking for safety of capital. You buy US Treasuries, and yields will be falling in a recessionary, deflationary environment. Yields will come down as a function of that, making bond prices go higher. So, one of the big trades next year is long duration bonds could well outperform the stock market, hands down.
I mean, if the Fed's going to buy them and cap yields and go back to yield curve control, yes.
No, even outside the Fed. So look, I mean, there are trillions of dollars in portfolio managers' books, right? So they've got to put capital somewhere, and then foreign reserves, they've got to be held somewhere. So if I want to store money, if I'm a foreign country and I need to store capital in the US dollar, I have to buy treasuries. I have to convert it to dollars in some form. So I buy treasuries to do that. So it won't be just the Fed. And yes, eventually the Fed will start reversing QT, go back to QE, because they'll have to buy the debt to support the treasury issuance. But there's enough buyers out there to generate a fairly strong return in bonds next year, even ex the Fed.
You think so? Even with Japan being a net seller, they sold $81 billion in treasuries in a single month. So the normal buyers of treasuries like China, Japan, Germany, the countries that run the large trade surpluses, they've had to import so much more energy. The consumer's not spending as much. So it seems like the normal buyers of US treasuries are not there anymore.
Well, and that, yes, temporarily, right? But remember, everything is a function ultimately of currency exchange. So let's set up a real simple example for a second. So you're China and I'm the US. I buy $50 billion a year from you. So if you want to maintain a strong trade balance with the US, what you've got to do is try to manage your currency to remain somewhat close to a peg of the US dollar. Because if your currency gets too strong, as an example, then I can't buy as much product from you, right? And vice versa. If the dollar gets too strong, it's not really good for you. So we try to keep those currency balances somewhat aligned, somewhat pegged. And the way you do that is it's called sanitization of purchases. China will sell $50 billion worth of goods to the US, but instead of taking that currency back into the yuan, which would make their yuan much stronger relative to the dollar, they buy treasuries. Now, because of what's been going on in China, what's been going on in Japan, they've been fighting a battle to try to just, keep things stable in their country. So right now, yes, they're net sellers of treasuries because that they're trying to weaken currencies relative to the dollar. That's been working. That's one of the reasons we have such a strong dollar. But that's going to change. And again, like we said before, everything cycles. So when the next cycle comes, and they need to bring those currencies back closer in line with each other, which they eventually will, they're going to be net buyers of treasuries again. So, these temporary movements are not permanent cycles, right? So that's the trap you want to try to avoid, is assuming that what's happening right now is a permanent new state of reality. And that's probably not going to be the case.
Well, speaking of cycles, there also, despite high commodity prices, there was also not a lot of new supply that came online from a lot of these commodities. So even if we do have a recession or depression, we could be looking at a similar cycle to 2020 and 2021 repeating again because of government and central bank policies where there's supply side problems for a lot of these food and energy related commodities 6, 12, 18 months from now again.
Yeah, no, that's true. The commodity outlook is going to be very interesting because you do have shortages of a lot of stuff, right? I mean, you got shortages of energy, shortages of food, and there's certainly you can certainly make a fairly strong case for higher commodity prices. The one thing and just the one thing to take away when making a bet in your portfolio. So remember, is we're talking about portfolio management, and so we can have a thesis. And then we have reality, right? And so as a portfolio manager and managing your own portfolio, the thing we've got to be careful of is not get too set on our thesis, like where we're going, this has to be this way, because more often than not, things turn out not to be that way, especially when we're talking about more of the extremes, right? A big dollar collapse, or, gold's going to go to $5,000 an ounce. I'm not saying it can't, right? But there's a lot of people that get into these kind of mindsets that say this has to happen because of A, B, C, and things don't always work out that way. So you can make these bets, and I certainly am telling you, I'm not telling you not to make the bets. Just be aware that you may have to change that thesis next year as reality comes into focus. The dollar might be stronger next year. It could be a lot weaker. Interest rates may go up. They could go down for different reasons. Stock market, could do better, could do worse because of changes of the Fed policy, et cetera. So, as a portfolio manager, just, it's great to talk about these ideas and these theses and these concepts. Just remember, though, we may have to change as the facts change.
So how do you manage risks then? Do you get stopped out of trades a lot? Is it all about position sizing and stop losses and things like that then for managing your thesis?
So it's a kind of a multi-pronged approach. Yes, we use stop losses. Yes, we use position sizing. And then also part of it just comes down to managing the trade, right? So let's say that let's go with a thesis for a sec that that gold is going to go to $3,000 an ounce next year because of real yields. Okay, so that's the thesis, and I think we could definitely see some higher gold prices next year. I'm not. By the way, the $3,000. I just picked a number out of my hat. I'm not. I didn't set a value target there. I'm just picking a number.
Yeah, I mean, we're right under 1,800 right now. So I mean, it's not totally unreasonable.
Sure. So, but I just picked it. I don't want anybody to think, oh, Lance said gold's going to 3,000. That's not what I'm saying. I just picked a number. But but right now, gold has really been kind of struggling this year. Finally got a little bit of legs under it. For having inflation running at 7, 8, 9%, gold certainly wasn't the inflation hedge this year that we all expected, right? So there's a good example of a trade that didn't work out as we thought it would. But let's say we're going to enter the trade. So the first thing we do is we buy 1%. Say we're going to own 5% of gold in our portfolio. You buy 1%. If the trade begins to work, you begin to add to that trade as it works, right? And one thing that investors do that leads to more mistakes in a portfolio than not is they go, oh, I think gold's going to go to $2,000 an ounce, whatever it is. And so they buy 10% of their portfolio in gold today, and then it goes down for some reason, right? And they get stopped out. Well, when they just sell it, right? They just like, well, that didn't work. I'm just getting out of the position. I just lost a bunch of money. And then they don't come back and buy it. Now that it's cheaper and gold's actually in a better position, they won't come back and buy it because they just got burned. And this is that, kind of psychological tendency that we get into. So a better way to enter a position is to scale into it as it's working. If I have 1% in gold and it doesn't work, I can sell it. It's no harm, no foul. It didn't hurt me, right? And then I can kind of go, okay, well, why did my thesis work? What happened? What changed? And then maybe it's just a better price. Maybe I was just too early getting in, so I can buy that position back at a better price, start rebuilding my position. When it works, don't forget to take profits on the way up. The other thing that investors do too much is that they get hung into a position like, man, I'm making all this money in gold. And then commodities have a really nasty tendency to reverse very sharply, and you give up a lot of gains very quickly. Don't forget to take profits along the way either. Manage your position size. If your position is 5% and it goes to 6%, you trim it back to 5. Then when it goes to 6 again, you trim it back to 5. And you keep doing that until at some point you get stopped out at some level at a higher price. But you've been making money along the way, and you don't wind up just giving up all of your gains. And this is that psychological pattern that investors get themselves into, is they buy stuff and they get convinced that it's just going to go one way. It's just going to go up forever, and it's never coming down again. And then when it eventually corrects and they give up the vast majority of their gains, or worse, turn a gain into a loser, then they sell it because now they're done with it and they're going to do something else. And that's why most investors don't make money investing and managing their own portfolio, because they make I call these one-sided bets. People invest their whole portfolio into a one-sided bet. And then when it doesn't work, they cling to it, hoping to get back to even, which eventually they might, and then they get out and they're done investing, right? So
that's exactly what has happened in Bitcoin and crypto. I mean, like, I was getting in arguments with a bunch of trolls, and when Bitcoin hit 69,000 and all those Super Bowl commercials were being run by all those crypto exchanges that we know now, a lot of them are frauds, or the company never had any profits. And the people were just setting higher and higher price targets. I was seeing like, I'm all in Bitcoin. And then people were saying that I was just seeing these posts all over social media that I'm all in Bitcoin. Bitcoin solves everything. If you're diversified and you're invested in stocks or real estate or gold or commodities or anything, you're a gambler. Only smart people buy Bitcoin. And they were just setting, higher and higher price targets, 150,000, 200,000. We'll be at 1 million in 12 months. I was just laughing that like we're topping here.
No, yeah, absolutely. There's the old thing about, the magazine covers. We start seeing stuff on magazine covers. Super Bowl commercials are the same way. though, when you see when people, start naming stadiums, after something, right? You're at the top, right? And that's where
you're in Texas. You had Enron. Yeah, you had the Houston Astros Stadium was Enron Field, I think, at one point.
Absolutely right. And I'm not saying that everything's a fraud, but Enron was a fraud, by the way. I know probably a lot of your listeners like Enron. What? That's way back before your time. So but yeah, I mean, but when you see these things of irrational exuberance, and that's all 2020, 2021 was, right? You just had this massive flood of liquidity, too much money, chasing too few assets. We were writing articles, to your point, Jason, about why cryptocurrency was going to fail, why NFTs were, pet rocks were not going to work out well. I mean, you could just clearly see the writing on the wall. And, you got to remember, I've been managing money for 35 years. So I went through the crash of 87, 99, 2007. I've been through all these, right? I've seen these same things happen over and over and over again. And you keep hearing, well, this time is different. SPACs are different. No, they're not. We've done this before. We did it back in 99 and 2000. We just called them different things. We've done these, cryptocurrency type of things in the past. We just called them different things. We called them portfolio insurance in 1987. So, there's no new invention on Wall Street when it comes to investing. And the one thing you can guarantee yourself is when there's an irrational exuberance of too much money chasing too few assets, it always ends badly. It's just a function of what triggers it.
And this is the risk that the average person, the trader becomes the investor because they buy and hope that they get their losses back, that their losses come back, and then they just keep buying the dip. But in a bear market, when you keep buying the dip, you run out of cash.
Yeah, that's right. And this is part of the problem with passive investing. And look, one of the big fallacies about managing money is that active funds can't beat a passive index. And that is complete hooey, right? Because there are plenty of funds out there that over very long periods of time have absolutely slaughtered the index. Peter Lynch's Magellan Fund is a good example. Fidelity Contra Fund is another good example. American Growth Fund, which has been around since 1978 or something like that, is just absolutely crushed being an S&P index investor. But what you hear from the mainstream media is like, well, active managers didn't beat the S&P last year. That may be the case, but they crush it over the long term because what active managers don't do is they don't give up as much of the market during downsides. Good managers don't give up as much of the downside during a decline. And even if they underperform when the markets are going up 1 year or 2 years or whatever, they're going to get, because they're not spending so much time getting back to even, they begin to outpace the market over time. And, one of the best examples of an active manager that crushes the stock market that everybody idolizes, Warren Buffett, right? But yet you see all these advertisers like, oh, well, all you can do is just buy the index. That's the best you can do. Yeah, you'll be average, you'll get some return, but what's going to happen is the psychological impact is going to happen to you. You're going to wind up selling your passive indexes during a bear market. You're going to buy them too late in the bull market, and you're going to wind up underperforming over the long term. I mean, study after study after study, shows these behavioral biases, and this all leads right into the fallacies of passive investing. The only people that benefit from passive investing are the firms that issue the passive indexes, because all they do is collect a fee every year like an annuity, and they just continue to grow profits while you're trying to figure out how to grow assets. So if you want to beat the markets over time, you're not going to beat them every year. The goal is not to lose, and this goes back to portfolio management we were talking about a second ago, using stop losses, doing position sizing, taking gains, raising cash from time to time. We went to 35% cash in January of this year. Our portfolios are down this year. We're down about 8% this year, right? But that's okay because we outperformed the markets, in the 2 years prior to this. We're outperforming this year, and next year we'll get some more leg up on the S&P next year. So that's okay, right? You don't have to make money every year. The goal is not to lose so much money in a year that you spend the next 2 or 3 years just trying to get back to even. And because getting back to even is not the same as making money.
Yeah, I think the goal for a lot of these active portfolio managers is to try to buy low and sell high, unless they're a trend trader. They're trying, which is more short term, and they're trying to ride a trend up before the trend drops.
Right.
But you're seeing Warren Buffett's active money managers I follow, like David Einhorn, Warren Buffett, they've been increasing position sizes to profitable oil and natural gas companies.
Yeah. And look, it's and back in late 2020, we recommended, buying energy stocks because nobody wanted them. Everybody hated energy stocks, and those have been a killer trade, right? I mean, we've made. I said 2020. It's November of 21, and those have been a killer trade this year, right? Energy stocks are up 47% versus the market's being down 20. So, that's been a great trade. Now, it's not going to last forever. When you have a global recession, oil demand will drop, prices will come down, profits will fall, and energy stocks are going down. Right now, as a good example, there's about a 20% spread between energy stocks and oil prices. That deviation can't last long. There's a very high correlation, for obvious reasons, between oil prices and energy stocks. So that gap in performance is because of people still chasing energy stocks right now because it's the only place that's been working this year. But probably next year we see that gap close. Energy stocks come down in price, and it'll be another great buying opportunity. They're a little bit overvalued right now, but it's one of those things that if we do get in a global recession, oil prices are going to come down, and that's a function. So.
Well, one of my day jobs was I was also oil and energy stock analyst, and I think like a lot of the problems, Lance, are with government policy, because in places like the European Union, you've just had oil and natural gas drilling bans in so much of their landmass. So you have clear, because of these ESG policies and windfall profits taxes, there's still consumer demand long term, especially for things like natural gas, which is cleaner for electricity, and then nuclear power. So there's still these long-term demand growth things, even if there is a recession or depression, but long-term electricity. I mean, I think electricity still grew during 2020 when people were at home during the pandemic. And I think electricity, the numbers just came out from the US Department of Energy. I think they still grew anyway here in the United States.
No argument. But remember, prices aren't set by demand.
Yeah.
Prices are set by Wall Street. Because remember, what sets prices on the NYMEX is oil and commodity traders that are buying and selling oil and gas contracts. So if you have a global recession, then the belief is that demand will fall. And you're right, long-term demand is going to be there. But the belief, at least in the short term, will be that demand will fall and oil and gas traders will sell commodity contracts, oil prices will come down. That'll be your buying opportunity, exactly to your point, right? Because those demand shifts are not changing. And one of the big jokes about, climate change and buying electric vehicles, et cetera. That's awesome. Buy electric vehicles, save the planet, build a wind turbine, build a solar farm. That's awesome. Those have a bigger carbon footprint to build them than actually building a nice vehicle. So
there's video interviewing people who buy an electric vehicle, and you ask them where the electricity comes from, and they just say out of the outlet.
No, exactly. But to your point, though. But again, look, oil prices go up, oil prices come down, demand grows over time, and that's just a function of the world we live in. But so again, just from portfolio, we're just talking strictly about a portfolio management standpoint. When something performs as well as it has this year, I would be a net seller of energy today, looking to buy it back later, because whenever you have this big of an outperformance in a given year, contrarian investing says I want to buy what was most out of favor, right? What is most hated?
Gold's the most hated commodity the last 2.5 years because, like you said earlier, it has not performed to the government inflation rate of the CPI. We did not get gold and silver performing to the government inflation rate. So gold's more out of favor right now than oil.
No doubt about it. And then everybody hates bonds. Everybody hates tech stocks, right? There's some tech companies out there right now that are down 70, 80% from their peak that have strong fundamental balance sheets, strong cash flows, strong earnings growth, and a great business model. There's going to be some great money to be made in some of these tech stocks that have been just kind of thrown out baby with the bathwater. So again, just from a contrarian investing standpoint, we want to start looking for those really hated opportunities that could very well, now they're not guaranteed, nothing's guaranteed in the stock market, but If you ever have you ever seen those periodic tables of asset returns? You see them from like JP Morgan and others, and it's like a quilt of period. It's like a periodic table, like we saw in chemistry class in high school, but it's just asset returns. If you ever look at one of those, look at what's at the top in any given year, and then look where it is the next year. And more often than not, you'll see something that's at the top 1 or 2 years. It's at the bottom of the return structure in the next 1 or 2 years, and it just goes back and forth over time.
That shows how things tend to cycle. Yeah. And the average person doesn't think that a lot of these asset classes and markets tend to work in cycles.
Absolutely. And, and to your point, gold's at the bottom of the performance class this year. So, if I was going to be a gold buyer, next year could be a much better year for gold, to your point.
And if energy prices come down, diesel prices come down, electricity prices come down, that would actually benefit the gold miners, because you have gold prices around 1,800 and you have falling input costs.
That's right.
So the commodities are interrelated like that. So if one commodity is going up or down, that could actually benefit or hurt another commodity producer in a different type of industry.
Yeah. And just in all fairness, Jason, I mean, we manage wealth for high net worth retirees, basically. So we're not big commodity traders because of the volatility. I agree with all your statements. I just want everybody to know that I'm not personally a big commodity trader because of the assets that we manage for our clients.
Well, since you brought up volatility, actually, I want to get your thoughts on what Felix Zulauf said over on the Adam Taggart interview on Wealthion, because he said some very interesting statements. I've actually been talking about this for the last 6 months, that because of government and central bank policies and intervention, I expect a lot more asset price volatility going forward and shorter boom and bust cycles because of all these different levers that the governments and central banks are pulling, whether it's bad energy policy, taxes, raising interest rates. I mean, even in England, in the span of a week, you had pension fund bailouts, and then they were trying to raise interest rates and also buying bonds at the same time. I mean, that's a lot of messed up distortions at the same time.
Absolutely. Look, there are some things that I can't quantify. And again, this is where, first of all, I agree with what Felix Zulauf said. In fact, when I was doing a segment with Adam after that interview, I said basically the same thing he said and didn't even realize it. But, we have a lot of the same views. And, the one thing I can't quite get my head fully around yet is the government and the Federal Reserve, not just domestically, but globally, right? So central banks and governments globally have intervened so much for so long that I don't know how you get yourself back to some level of normality in terms of functioning.
You can't.
You really can't.
Look at Japan, right? You can't.
Yeah.
I mean, that's the path. It seems that the European Union, the United Kingdom, the US, a lot of the larger developed countries, they seem to be following what Japan did for the last 30 years.
I know. And I don't know why you want to be there. Right. I mean, Japan.
Well, I don't. Is it really by choice though? I mean, it's out of desperation because Japan didn't let their banks fail. During the real estate bust, their bust 30 years ago, they didn't let their banks fail. They turned them into zombie banks. Right.
Well, but Jason, that's the point, right? I work. Oh, so just quick sideline here, right? So I have 4 kids. I have one that's 22 that lives in Germany. He's about to move to the UK. He's experiencing socialism firsthand, and he's figuring it out why it sucks. I have 2 kids in college and 1 in high school. I worry about their future because of where we're headed. The last 12 years has been, kind of like this nirvana in the economy, right? You just had so much liquidity, so much money. The average return on stocks over the last 12 years is 4 full percentage points higher than the long-term average. And you can't generate that economically, right? Economically, you can only generate, the growth rate of the economy is about what you're going to get out of stock. So if the growth rate of the economy, just say, is 4%, you should expect about 4% growth out of equities because that's the revenue that's going to be generated from the economy. It shouldn't outgrow that over the long term. Now, stocks can outgrow the market or the economy from one year to the next, coming out of a recession, going into a recession, whatever. But over the long term, and you go back to 1900, the growth rate of the economy is about what the capital appreciation of stocks is, plus dividend, less inflation. So that long-term average is 8%. From 2008 to 2022, we generated 12% rates of average returns. You can't do that without all this financial liquidity driven support. We spent $10 for every dollar's worth of economic growth since 2008. You can't keep injecting $42 trillion into the economy. You can't do it. But that's what we did. And so you're right, Jason, we have a point, a choice. We can either stop doing that, go through a really nasty recession/depression, because it's going to suck for a couple of years, but you're going to reduce your debt levels. You let people file for bankruptcy. You let them relocate to areas where they can start renting again and get into a place where there's jobs available for them. And you allow them to restart. But that's what's going to create real economic growth. You're going to have to let the major banks go bankrupt, because they should have gone bankrupt in 2008. We should have allowed that to happen. There should be no JP Morgan. There should be no Bear Stearns. There should be no Goldman Sachs. They should have all gone belly up. And what we would have today is a much more diversified banking system around the country. Yes, 2-3 years, it would have been terrible. It would have been a horrible economy. But we would be so much healthier today. And to your point, we're now so far down this rabbit hole, we can't stop. And so what I worry about for my kids is their future is not great, because they're not going to have the opportunities to create capitalism. They're not going to have the ability to produce higher rates of wealth and prosperity that, I had and that our parents had, in this economy. It's not going to be available to them anymore. And that's the sadness about all this. It could be, but somebody's going to have to stand up and say, we've got to stop this. We've got to wean the economy off of all this artificialness and get back to the basics of how an economy works: supply, demand, and most importantly, production. We've got to produce in order to consume. And we've got 7 million people sitting outside the labor force right now because they just don't feel like producing.
Well, also, you can't have capitalism, real capitalism, without bankruptcy. So if the government's going to pick and choose winners and losers, bail out entire industries, let small business owners fail while saving large corporations or saving entire industries, I mean, we haven't had real capitalism for a long time then. And that's capitalism right. Still gets blamed.
Yeah, that's right. Look, I mean, the one thing that makes the experiment of capitalism work is the rule of law. And without the rule of law, you don't have capitalism. What you get is corporatism. And to your point, that's exactly what we have, because we keep bailing out companies that should go bankrupt. In 2020, we bailed out Boeing. They spent over 6 years using all of their capital to buy back their own shares to enrich their executives inside the company. And then when they get into financial trouble during the economic shutdown, they go running to the government for a handout. No. You should file for bankruptcy, reorganize. What's the problem with bankruptcy? Everybody's so scared of this word bankruptcy. All it is, it says, guess what? Bondholders, if you own the bonds in the company, you're going to have a claim on the assets of Boeing during the bankruptcy process. If you're a stockholder, I'm sorry, your shares are now worth zero. You go to the bankruptcy court, the bankruptcy says, okay, creditors, you can get 50 cents on the dollar. The debt is wiped out. Boeing, you're back in business. You got a clean balance sheet. Get back to work. Start flying people around the country again. That's what bankruptcy is. The people that take the hit are the bondholders and the stockholders. The company has to reorganize. They've got to get lean and mean, and it makes for a healthier economy. To your point, we've gotten, for some reason, we're scared of allowing a company to go into bankruptcy for some fear it's going to create some economic disaster. Like Boeing is going to go away and they're not going to make planes anymore, or American Airlines isn't going to fly anymore. That's not what bankruptcy is, right? In the majority of cases, it's a reorganization that allows the company to be healthier coming out of the bankruptcy process. But yeah, a lot of people that invested money, people buying shares of Hertz when it was on the verge of going bankruptcy, well, it goes bankrupt, you lose your capital. That's on you for being a bad investor.
Yeah, also Boeing spends a lot of money, tens of millions of dollars on lobbying. So they get unbid government contracts, and then they have both political parties. They have control politicians in both houses of Congress. trying to make sure that they don't go bankrupt, so that you have the government intervening. So in a free market, they probably would have went bankrupt, but the government's like changing the rules. The government's creating all these extra liquidity programs for them, or just sending unbidded contracts, extra stuff their way. I mean, Trump and Democrats were both doing that for the military industrial complex companies.
Yeah, look, now, but see, Jason, this is corporatism, right? So this is what I'm talking about. What we, you and I, right? So you and I participate in what we call capitalism. Capitalism is not dead. Every day I get up, I go to work, I have a business that I started with three partners, and we run a business. We run a successful business. That's capitalism. Corporatism is what you're talking about. It's where corporations do things where they begin to lobby Congress to get special perks, and they invest a lot of capital into getting legislation approved that benefit their companies, and removing restrictions that allow them to do things that really they probably shouldn't be doing. For instance, share buybacks, as a good example, were illegal until 1990 because they were a form of stock market manipulation. After Bill Clinton decided to put a cap on executive salaries at $1 million, Wall Street goes, well, we can get around that. We'll do stock buybacks. So they lobbied Congress heavily to bring stock buybacks back. And now we've got companies like Apple buying $500 billion worth of stock back to lower their EPS. The only people that benefit from share buybacks are corporate insiders that sell their stock options and grants of stock back to the company over time. And that's who really benefits. And that's how these, and again, corporations are incented to keep their asset prices high so that those stock buybacks will mature in the money, and that's how they build a lot of wealth. But that's all corporatism, right? Corporations should not be allowed to influence political decisions. I mean, this is the problem we've gotten ourselves to in the economy. It's supposed to be you and me. We vote for our congressman, we vote for our senator. They go to Washington and they vote what we elected them to do. But instead, what we've got today is corporations intervening, creating, writing bills that get passed that benefit them and don't benefit the people. And this is why people are so upset. And they say, well, capitalism sucks. It's not capitalism. Capitalism's fine. Capitalism's alive and well. You can go out today and start a business and be successful, right? You can go get an electrician's degree, go start an electric company, an electrician's company, and start doing work. And you can build a very nice life doing that, right? That's capitalism. Corporatism is what sucks. And that's what everybody sees. And that's what everybody's upset about. And we just allow it to keep festering because the people, we've got the government in bed with the corporations who are in bed with the lobby groups, to your point. And look at what's coming out of Twitter lately about all the stuff that was going on in 2020 behind the scenes at Twitter. I mean, that should not be going on in this country, period.
Yeah, we have the merger of state and corporate interests. You called it corporatism. I mean, it's basically fascism. So the merger of state and corporate interests where profits are privatized. If you're a large company, you're a large US bank that's connected to the Federal Reserve System, military industrial complex, big pharma, big tech. Those are the 4 or 5 main industries. Your profits are privatized, your losses are socialized. You have one or both political parties willing to come in and save your company because you're spending enormous amounts of money on lobbying, and you have lots of friends in the Senate and the House of Representatives or in the White House.
Yeah. And that's again, the problem with that is that people can't separate that out. They think it's capitalism gone wrong, and it's not. And we need to keep those two things very separate so that people can realize what I'm voting for when I go to vote for my elected official, regardless of your political affiliation. I'm voting for the person that is going to fix these problems that are impeding my ability to grow wealth. It's not capitalism. Capitalism is fine. Capitalism is alive and well. You have that opportunity, as I said, to go and build wealth in this economy. But it makes it very difficult when, to your specific point, fascism, or the way I put it a little bit more loosely, is corporatism. Try not to be completely,
Well, I just cringe. I'm sure you hear this too, Lance. I just hear the term we're in late stage capitalism now. And I was like, that's a Marxist term. That's a loaded Marxist term. Trying to blame.
All day long. But again, people need to be educated about what they're voting for. And a lot of these policies that they think they're voting for, you want free college, you want free this, you want free that. That is not the pathway that you want to go down if you want a better life.
Oh, it's not free. Speak to the people in Canada who are paying over 50% of their income tax for free healthcare. And then if they have cancer, they might have to wait over 6 months for a doctor.
I know. But look, we've had these conversations, and again, it just kind of falls on deaf ears. But and again, just people need to understand the economic ramifications of what they vote for, because the where we're headed. And, again, I've written articles about the Japanification of the US. Japan is not the role model that you want, economically speaking.
Oh, I agree. They're hitting the wall right now, right? So basically, from a financial history perspective, as we wrap up here, countries have not been able to get away with what Japan has been able to get away with for 30 years. Historically, governments and central banks, when they get into this type of trouble, they can either save their government bond market by printing currency, or they have a currency crisis where their currency gets devalued. So Japan appears to be finally hitting a wall.
Yep, absolutely.
Well, Lance, I really enjoyed our discussion today. If my listeners want to take a look at your work, maybe read some of your articles, take a look at your new show with Adam Taggart over on Wealthion, how do they do so?
If you go to our website, realinvestmentadvice.com, you can subscribe. We produce a daily market commentary every day with it's like 2-3 minutes to read. We give you a market update as to kind of where the market's trading, kind of support levels, those type of things. We produce a daily blog. We have a daily radio show, a daily podcast, a weekly newsletter that you can subscribe to as well. That's full of stock market analysis, stock screens, all kinds of stuff to help you be a better investor. And then, of course, you can also get our weekly market wrap with Adam Taggart as well. All at the website, realinvestmentadvice.com.
Excellent. Well, thank you so much for the discussion today. I think we'll have to have you back on again soon. I think 2023 is going to be a very volatile year because of all the craziness that these governments and central banks are doing. And then on top of that, you have these pension funds, and it's not just the United Kingdom. We have a lot of other pension funds that have put on these leverage hedge fund trades. I think there's going to be pension fund bailouts and pension fund problems coming soon to all these different countries.
I don't disagree, and I'd love to do it.